Hello, you're watching Proactive. I'm joined by Anthony Ginsberg, the CEO of Gins Global Index Funds. Anthony, great to speak with you as always. And we're talking about the Hunt Gins Tech Megatrend Equal Weighted UCITS ETF. How are you doing, Anthony?
Great to see you, Stephen. Yes, it's been a volatile time the last week or so. We've been somewhat protected by our equal weighted approach, as we were just saying, and also having a global approach. At the moment, we have 120 holdings, as you recall, spread across 8 sub-themes, from robotics and AI all the way to cybersecurity, cloud, digital media, some blockchain in there as well. So it's a very broad exposure to tech mega trends going forward. And actually, we see AI itself growing in leaps and bounds. The projections are to have over $2.5 trillion of AI spending, and that will actually overtake cloud spending. But both of them are in sync. They actually are two peas in a pod. Actually, the cloud holdings we have really benefited in a massive way from the AI spending growth, Stephen.
So, Anthony, to take a step back, we've seen quite a lot of pressure on the Magnificent Seven, or the so-called Magnificent Seven, over the past couple of weeks, pressure on the NASDAQ as well. Tell me why your equal weighting approach helps to shield you from this.
Yes, our mega cap holdings are roughly at about 8.5%, 9%, Stephen, and our top 10 holdings are below 14% exposure. That's dramatically different to something like the NASDAQ that would be almost 50% exposed to their top 10 holdings, as well as the mega caps generally making up almost half of those indices, or some of our competitor funds out there. So because of equal weighting, we typically have about just under a 1% exposure to each one of the 120 holdings. Interestingly, within each of the sub-themes, such as robotics or cybersecurity or digital media, social media as well, those are each having 15 holdings, 15 leaders by market cap for each of those sub-themes. So we typically are having leaders that are between large caps, some small caps, but primarily between large and mid caps, Stephen. So they're avoiding the mega caps or the Magnificent Seven massive price to earnings ratios in the 30s and 40s. Actually, our PE ratio at the moment is averaging around 18 times earnings. It's very different to a NASDAQ that's around 32 times PE at the moment.
So you don't really feel it so badly then when you do have these big volatile sessions in the markets?
Yes, I think it's fair to say that actually a number of our holdings are still trading at levels of 2021, 2022 levels. They haven't fully recovered yet. So we see the Fed tailwind coming up shortly, where we're expecting in September a Fed rate cut anywhere between 25 to 50 basis points, possibly now on the table. And that tailwind will typically help mid caps and regular large cap holdings, which is predominantly our space, given that the mega caps is only just under 10% for us. So the slightly smaller tech companies haven't actually had a full run or a full benefit yet. And this Fed tailwind, we're expecting well over 5 or 6 rate cuts next year into 2025 as well. That should help the slightly smaller tech companies, Stephen, who really have been left in terms of the recent gains. Although we did have a very good run over the last 90 days. In fact, in June, we were up about 7.5% in this fund. July was up. And typically what's happened is that the Magnificent Seven have dominated, but they've now fallen back somewhat. So we're actually expecting a broader tech run up as the Fed rates do start cutting between September and December.
Anthony, you also mentioned your global benchmark. Take us through that, because you have quite a lot of holdings outside of North America. So looking at Asia and Europe as well.
Yes, Stephen, we actually have only 59% exposure to the US. China and Japan are, plus Asia, represent about 20%. That's primarily things like robotics companies, some social media. We've obviously got some electric vehicle and future car companies. BYD is in there, Baidu is in there, Amazon's competitor in China, Alibaba, is there. So we have very sizable players who essentially have an oligopoly or sometimes a monopoly in the Asian world. But there are even South Korean holdings who are leaders in robotics. And as you see more onshoring towards the US, I mean, both the Harris campaign and the Trump campaign here are already pushing onshoring. So this trend, it may not benefit the US worker as much as we think. It may well benefit robotics. And they call them cobots as well, where you've got humans working increasingly on assembly lines with robots. So we're expecting a big showing from the robotics sub-theme. I should just mention that the digital media theme, where you have digital entertainment, online streaming, that's becoming increasingly dominant in the gaming space. So in Asia, they have the largest per capita online presence for cloud and gaming per capita. So certainly we are looking outside the US for opportunities as well. But essentially, it's a global benchmark. Europe's just over 10%. We have a little bit of Australia, some Scandinavian players in there, but it really is a global story for us.
Anthony, you said AI catching up with the cloud as a big theme. Are you seeing opportunities there at the moment?
Yes, actually, if you look at cloud and cybersecurity, they're almost like first cousins, because as the work from home phenomenon has developed, you've seen increasing usage of both cloud and cybersecurity, and now the outsourcing to actually utilize algorithms and OpenAI and the ChatGPT, these sorts of large language models can't really be run internally. So we've seen a lot of the guys who require speed, whether it's banking, highly regulated industries such as healthcare, insurance, increasingly even supermarkets adopting more AI usage, but they essentially turning to the cloud providers, folks like Microsoft, AWS from Amazon, the Google Cloud, to utilize these algorithm and AI outsourcing features that they just don't have internally. So there's this big move to adopt cloud, but again, a multiple kind of cloud. We call it hybrid cloud, where you can actually, and IBM's benefiting from this. Their main feature is to switch, allow folks to switch between, let's say, a UK cloud or a Brexit cloud versus a US cloud. So it's become increasingly flexible, and no one's betting the farm on just one cloud provider. So cloud usage increasingly is benefiting from the shift to AI as well.
And Anthony, as we head towards the tail end of 2024, are you expecting more positive performance given those expected rate cuts coming through?
Yes, it should, as I mentioned, be a tailwind for the smaller and mid-cap and even large-cap players who really haven't benefited. We actually see a trend where there's more and more convergence across these different sub-themes. So things like robotics or gaming or even online streaming, the likes of Netflix, frankly, Tesla, they're all increasingly using AI. So this convergence across multiple tech themes is increasingly important. And it's very hard to time it, Stephen. That's the reason why we rebalance every 6 months according to our selective rules-based index. And by having 120 holdings and rebalancing, we can take profits after 6 months, and then it essentially rebalances. So it's about a 15% weighting for each of the 8 sub-themes.
Well, Anthony, I hope you'll keep us posted on any progress with all of those sub-themes. Thank you very much for the insights today.
Thank you, Stephen.
That's Anthony Ginsberg, the CEO of Gins Global Index Funds.